Hello and welcome to today's StreetSmarts video. My name is Billy Cooper. I am an investment management planner here at Howe Rusling. As we approach the year's end and folks begin having year-end reviews with their portfolio manager, the conversation will likely address realized gains and inevitably how that may affect their tax liability. Well, in this episode of StreetSmarts, I will arm you with a strategy to lower your realized capital gains and maybe even a portion of your taxable ordinary income. Now, we all understand as investors that not all investments will turn out a winner. However, you're in luck. Fortunately, these losers can actually be used to your benefit with a strategy called tax loss harvesting. In a few moments, I will talk you through an example so you can see how the math works. But first, let's walk through the basics. So let's say that you are reviewing your portfolio and you notice that one of your tech holdings, we'll call company A, has had a great year and appreciated significantly in value. While that is a great thing, if the investment is held within a taxable account and sold, you must report the gain to the IRS, which is the difference between the value at time of sale of the investment and the purchase price or the basis. Assuming your AGI falls above the threshold of about $39,000 if filing single, or $78,000 if married and filing jointly, you will have to pay taxes on this capital gain. Now, this is where the strategy comes into play. While you notice that you'll have to report the large gain from your position in company A, say you conversely have a position in an industrial company we'll call company B that's underperforming and losing money. What you can do is sell this underperforming position in company B for a loss and offset the capital gains that you will be reporting from your position in company A. And also, if your loss exceeds your gains, you can potentially offset up to $3,000 of your ordinary income for that year. And then whatever losses are left over may be carried forward to offset income in future tax years. Okay, so now let's talk through an example with actual numbers. So to stay consistent, let's say a few years ago you bought $20,000 worth of stock in company A. Today, you sell the shares in company A for $40,000, recognizing a gain of $20,000. That's awesome. But again, assuming your AGI falls above the threshold, you will have to pay taxes on this gain of $20,000. At the same time, let's say you also purchased shares in company B a few years ago, which are now underperforming. Thinking proactively, you sell these shares in company B, realizing a loss of $25,000. With this loss, you're effectively able to offset the $20,000 gain and still have an additional $5,000 left over, which may then be used to reduce your taxable ordinary income by $3,000 and then carry forward the additional $2,000 for the following tax year. Now, before wrapping up, there are a few rules to abide by while harvesting losses. The first restriction is that a long-term loss would first be applied to a long-term gain, which is an investment held for more than a year. Now, a short-term loss would be applied to a short-term gain, which is an investment held for less than a year. If there are excess losses in one category, these can then be applied to gains of either type. The second restriction is that if you sell a security at a loss and buy the same or substantially identical security within 30 days before or after the sale, the loss is typically disallowed for current income tax purposes. This is what we call a wash sale. With the year's end around the corner, our portfolio managers at Howe Rusling are working diligently to identify opportunities to harvest losses on a client-by-client basis with the understanding that each client is unique with their own set of needs and objectives. If you have any questions or would like to hear more about how tax loss harvesting may pertain to you personally, I recommend you reach out to your Howe Rusling portfolio manager, as they would be more than happy to walk you through our process and how it may benefit you. I hope to see you next time, and thank you for tuning in to StreetSmarts with Howe Rusling.